Hi everyone, my name's Darryl Panes, CEO of As Good as Gold Australia, and this evening once again I'm joined by my brother Brian, partner at As Good as Gold.
Thank you, Darryl.
And tonight we speak with Alasdair Macleod, advisor to As Good as Gold Australia. Good evening, Alasdair.
Good morning, Alasdair.
Good evening, everyone in Australia.
Alasdair, so much, and I keep saying this, but so much happening in the world at the moment. It's really hard to keep track of it all, but and all happening in a very short space of time. And we, at As Good as Gold Australia, are under siege. And I mean that. We've just completed our second event with John Adams in Newcastle. And now we're heading to Wollongong, and we've only had it up for 2 or 3 days, haven't we?
Yeah.
And we're just about packed out. We're way over 100 people, and the venue only takes 150. So we're looking really good there. And that's John Adams' home turf. So he's going to be at his very best at Wollongong. It's going to be an absolutely great night. So, and that's the 18th of August, Thursday, the 18th of August. So you can get your tickets through Eventbrite. So if you want, go to our Facebook page and check out the link there and connect with Eventbrite. Pick up your tickets, but you'd want to be very, very quick. As I said, there are very few tickets left. Next stop is Melbourne, and that's going to be a real big one. That's going to be Wednesday, the 31st of August. So that's the first time we've quoted a date. But we're on now. And tickets are going to be available in the next few days for that event. And we do have a venue that'll take 250, 300 people. And we got a pretty good feeling we're going to fill that up. So the other exciting news, of course, and we'll keep reminding our viewers of this, is that we will be opening our Melbourne office in Collins Street within the next month. So we're really excited about that. Really looking forward to getting over to Melbourne. So very busy time for As Good as Gold Australia, but we are gluttons for punishment, aren't we, Rob?
We certainly are. And Darryl didn't say, Alasdair, that we just finished off the Adelaide seminar, and the room we booked was for 200 people, and we fitted in 230. They were they're standing room only. So we were very happy with that particular point of view.
And of course, we're going to run another event in Adelaide in about 6 weeks' time for those who missed out, because there were 80 people who couldn't get into the last event. So we're thinking of you, and we're going to run another event just for you guys. So what I'd like to do tonight is start, and if I look cold, it's probably because I am cold, but I'd like to start tonight by taking another look at inflation, Alasdair. Australia's inflation rate at the moment is 6.1%. Well, that's what the RBA is telling us.
Tell us.
It's probably more like 12, but they're telling us 6.1. And it's expected to peak at 7.75% by the end of the year. US inflation rate is sitting at 9.1. And just as a matter of interest, the last time the Australian inflation rate was at 6.1% was June 2001. So we're going back a very long time ago. So it looks like Jamie Dimon got it right. It's rare, but he got it right when he said there was an economic hurricane heading towards the US. But I think clearly there's an economic hurricane about to engulf the world. So here in Australia, there's a gentleman by the name of Chris Joye from Coolabah Capital. Came up with some pretty interesting comments the other day, and I thought certainly worth mentioning. Chris has confirmed that the annual pace of Melbourne house price losses since May 2022 is 15%, and 22% for Sydney. So these are serious numbers, with an average of 13.1% for the 5 biggest capital cities. He also says that if the RBA interest rates increase at the rate of 0.5, which is the expected, 0.5 of 1%, till year's end. It'll be well over a 3% cash rate, and the average mortgage rate would be around 6.7%. That's about double the 3.45% it was in April of this year. He says that would lead to the biggest housing price crash in living memory. You've been talking about inflation, for some time now, Alasdair, and the ramifications of high levels of inflation. And you've been right on the money. So I'd like your thoughts, if we could, on where we're going from here.
There are quite a few elements to your question there, and I think I'll start off about the inflation story, and then if you can remind me to come back to property, perhaps we might discuss that.
Yes.
I mean, only 6.1%. Really, you're lucky.
Yeah.
I must tell you that,
I'm with you.
I must tell you that in the UK, I think we're running at 9. I think the official rate of the CPI is about 9%. But we also have an older statistic called the Retail Price Index, which has been abandoned by government statisticians, officially because they didn't think it was a proper representation of, and it wasn't sort of in line, if you like, with the international agreement of definition of the Consumer Price Index. But actually, the reason they've dropped it's far too expensive when it comes to indexation compensation for government stocks, whatever. Now, that is standing, and, please sort of hold on to a bit of wood here and don't fall over, 11.8%. That is the most recent figure already. Okay, so wow. The numbers are actually, in a sense, are immaterial, because what we're talking about is not rising prices, but the debasement of the currencies, the effect of the debasement of currencies on prices. That's really what it is. Every central bank takes the view that this is still transitory. They're not blaming it on their earlier policies of expanding the quantity of money in circulation, or the quantity of the circulating medium, as it were. What they're doing instead is they're saying, well, we had COVID, and then we had supply chain problems. And now, of course, we've got sanctions against Russia. And when Russia is defeated, it'll all return back to normal. The official forecasts of virtually every central bank, major central bank, significant central bank, is that inflation will return to target. And all they're doing in terms of raising interest rates at the moment is to try and stop it going sky high. They know it's going to go higher, but now they're talking about recession. Now, if you're a Keynesian economist, you actually don't understand prices. What you assume is that a recession is a situation where consumer demand falls, and with falling consumer demand, you get falling prices for goods and services. Now, there is a small element of truth in that, but you've got to look at really what is happening. What is happening is not so much the falling consumer demand. What is happening is businesses unable to recuperate the higher costs they hadn't been planned for in their production. And in many, many cases, they haven't got the stock because of the supply chain problems and so on and so forth. But at its very, very fundamental, any manufacturing business has the problem that it cannot make a profit on what it is now selling. It has to raise prices. But that is the source of the inflation, not, sort of a huge, great jump in consumer demand. The jump in consumer demand is there. And what is happening is that consumers, let us assume the average person has access to liquidity of $10,000. Okay. Now he's looking at prices rising. He is looking at product shortages on the shelves. When he goes into the supermarket, he sees empty shelves. empty of the things that he perhaps went in to buy. He looks at motor cars and he sees the prices rising. So what does he do with his $10,000? Well, the answer is that he reduces his $10,000 in favor of goods he doesn't necessarily need now, but reckons he will need in the future. And what he is doing is he is dumping his dollars in return for goods. The price effect of that is to drive down the purchasing power of dollars relative to the value of goods. That is what is happening. And this is the point that the central bankers either do not understand or don't want to understand or don't want us to understand. Because if they raise interest rates to, let us say, a natural level, the level which markets would expect interest rates to be at, then they're going to bankrupt businesses everywhere. And they're also going to bankrupt the banks that create the credit for those businesses to continue to function. And that is a crisis that nobody wants to move towards. So this is why everybody in the establishment, it's not just central banks, but you find that all government statisticians in their forecasts and all the rest of it, what they're doing is they're saying inflation is still transient. It's just taking a little bit longer than we originally thought to return to our 2% baseline. But I can tell you that the dynamics behind this are very, very different, and they ought to scare people into really thinking that, hold on, this is a real problem. Inflation is not going to stop. It is going to persist. It will drive up interest rates, the natural level of interest rates. And if the central banks are unable to respond to this, then what will happen is that markets will take over pricing from the central banks. And this is the dilemma which particularly affects the ECB, which has suppressed interest rates to below zero. It's now admitted very reluctantly that it needs to raise rates, so it's gone to 0%. The Bank of Japan is in a similar situation. But these banks also have the additional problem that over recent years, in the case of the Bank of Japan since the year 2000, they have done something which no central bank should ever have done. They have accumulated a portfolio of bonds, and in the case of Japan, also equities in the form of ETFs, exchange-traded funds, which basically means that if you get falling financial asset values, they're bust. They are already technically insolvent. I was calculating, this was beginning of this month, I sent out an article on the Eurozone situation, the Euro system, and I calculated that the likely losses for the Euro system, so we're talking about the ECB and all the national central banks, which are shareholders of the ECB, their total bond losses amounted to something like €750 billion. That's 750 billion euros. Their equity capital, their combined equity capital is 109 billion euros. So they're already almost 7 times into the hole. Now, since then, bond yields have stabilized. I would suggest that that stabilization is a temporary factor, and I think we are likely to see bond yields for government stocks to rise quite significantly over the next few months because of this inflation problem, which is becoming more and more apparent as we go on. And so what does the Euro system do? Well, the Euro system has got to recapitalize itself, and recapitalizing itself is easy enough when you've got a government as a counterparty. You can go to the government and you can say, right, we will lend you some money, but you put the money back into the other side of our balance sheet as capital. Yeah? We know it's a fiddle, but that's basically what happens. That's simple. Okay. But in the case of the ECB, they don't have a government to turn to, and their shareholders are the national central banks. So look at the position of the Bundesbank. The Bundesbank will be asked to make the largest contribution into the ECB's equity of any of the national central banks. This requires legislation in the Bundestag. The politicians are bound to turn around and say, well, hold on a minute. You're asking us for whatever the figure is, but we notice that there is a target 2 amount owed to you of over €1 billion. 1.2, I think, was the last figure I had, something like that. What do you intend to do about that? Now, you can see that the whole story is getting into the long grass, if I can put it that way. So the ECB has a huge, great problem. It's not a simple matter of recapitalizing the ECB. And then we look at the banks as well. I mean, the commercial banks, they have an average ratio of assets to shareholders' equity, book value, of over 20 times. I'm talking about the global systemically important banks, of which there are, I think, 7 or 8 in the Eurozone. Now, when I tell you that at the height of a bank credit cycle, it's usual to see banks having an asset to equity ratio in the region of 10 to 12 times, and that is regarded as rich and dangerous if there is a downturn in the economy. We now have a situation in the Eurozone where it is 20 times. So, almost double where previous peaks. How has it got there? It's got there, but very simply because the ECB, through its interest rate policies, has forced banks, if they are to make any profits at all, on declining margins to increase their leverage. And it's no accident we have exactly the same situation in Japan, where the Japanese global systemically important banks similarly have asset to equity ratios of over 20 times. So this is where we are. We cannot afford to admit that inflation is a problem. We must believe that it's going to go away. We know that what's happening is that we're moving towards a recession, so we can use that argument in Keynesian terms to turn around and say, what's going to happen is the recession is going to reduce consumer demand, which means that the pressure on prices rising will diminish, and eventually they will begin to diminish to the point where we can return to our 2% target. But it's a load of hogwash. I hope that answers that one. Now, let's turn to property. This is an interesting one, because we all have this problem, is that while interest rates are where they are, people are actually rushing out and buying property because they've got to have somewhere to live. So it's continuing to drive prices up at this stage because they can borrow mortgages at typically 3.5%, fixed for 5 years. They can still do that. So the sensible thing to do is to rush out, buy a house if you haven't got one, go and buy a house, take out a mortgage, fix the rate, whatever. If you can do it, if you got the, if you can do it, tick all the boxes, do it. That's what they're doing. If you look at the sort of middle class housing prices, then this is now less evident. There has been a huge move from, say, cities into the country and so on and so forth. That was driven predominantly by COVID. Then you had on top of that this sort of fear that prices are going to continue to rise, so you've got to get in and buy your house while you can. And now we have a situation where everybody's turning around and saying, hold on, mortgage rates are going up. This is not going to be good for the housing market. And indeed, nor should it be. The metric which you have to use is that if you want to retain your house, then either of two things must be true. The normal situation is that you must be able to afford to pay the mortgage whatever the rate moves to. So if, let us say, the mortgage rate doubles, and let's say your mortgage at the moment is $5,000 a year, or it's probably more like 10 actually, or 15. You've got to be able to afford it going up to over 20, maybe even over 30. Now, if you can afford to do that, then you can hold on to your house. That, if you like, is the normal way in which you would look at this situation. The other way to look at it is to say, take a very different view. It's the view which is encapsulated in the old story that if you owe £100, call it $100 to the bank, and you haven't got it, you've got a problem. If you owe $1 million to the bank, it's the bank's problem. Yeah. Now, so what we're looking at is a situation where when mortgage rates rise and people start defaulting on their payments, it becomes a wholesale problem. Now, you as an individual in that climate don't have the problem. It's the mortgage lenders that have the problem. And it's them that will be bailed out. And it's them that the government will turn around and try and subsidize or tell them don't raise rates or whatever. So what we're looking at, I think, with this inflation problem, because it is so widespread, it is global, it has only just started in a sense, then when it comes to mortgage rates, I think you'll find that the entire global middle class is going to be in the situation where they're effectively defaulting on their loans. Now, under those circumstances, I would suggest that it's not you that's got the problem, it's the lender that's got the problem. Mm-hmm. So anyway, those are my thoughts on it. In terms of what happens in inflation, the value of houses in real terms go down very substantially. And the reason for this is that you've got to look at a property, a residential property, in terms of its yield. Now, if you're living in, you've got the roof over your own head, the yield is the facility that it provides you. If, on the other hand, you're letting it to someone else, then it's the rental income. And the problem with rental income is that it never keeps up with the loss of purchasing power of that rental income. And when inflation gets to the point where it is really serious, then you find that the cost of maintaining the property is greater than the rental income that it provides. Now, at that stage, effectively, the property is worthless. But against that, what you have is the declining purchasing power of the currency. And that declining purchasing power of the currency probably means that, measured in depreciated currency, the value of your property probably hasn't gone down that much. Indeed, it might well have increased. And this is why I so often tell the story about what happened in Germany in 1923, that, you could buy a house in Berlin, a decent 6-bedroom house in a swanky part of Berlin, for $100. Now, $100 at that stage was readily convertible into gold at the rate of $20.67 to the ounce. So we're talking about a 6-bedroom house. You could buy that for around about $5. I don't know what the figure would have been in paper marks. I mean, it may have been worth 100, 200, 300 million, a billion. I don't know. That would have been considerably more on paper than you would have paid for it before the Great Inflation. But in gold, it was a calamitous collapse in values. And so this is where the balance in this situation lies. And I don't think for a moment that we're going to see that sort of replay that we had in Germany in the 1920s, because they were using currency as a far greater mainstay of government finances than we are today. No, we could get there. But I think that the situation is more likely to be driven by a global financial crisis. I mean, I've just mentioned the situation in the Euro system and also in Japan. We get major currencies falling over, if you like, or financial systems falling over. And I mean, if the Eurozone falls over, it'll take out London. Of that, there is no doubt at all, because where is everything cleared? It's all cleared in London, apart from the Target 2 system, which is between the national central banks and the ECB. But all the commercial settlements are cleared in London. The Europeans hate it. I mean, the European the Brussels establishment thinks this is completely wrong, that all commercial banks do all their clearing in London. It should be done in Paris, or, we should have it in Berlin or something. But, I mean, the reality is that if that falls over, we get taken out. And if we get taken out, I can't see how Wall Street or New York will survive. So, what we're looking at is we are on the precipice of something that could be more serious than we have ever seen in our lifetimes, certainly more serious than anything that we have seen since the Wall Street crash and the subsequent depression, and possibly even more serious than that. We're looking at the end of the current financial system, which has evolved over the last 200 years. So this is, I think, an extremely important moment. Understanding inflation, to your point, Darryl, is, I think, the most important part of realizing what is ahead of us, what the dangers are, and therefore how do we see ourselves and our families and our close friends through this potential crisis.
Yeah, look, it's I think of Egon von Greyerz in a situation like this, where he made reference to politicians around the world. And he said, Darryl, he said, make no mistake about this. All politicians lie all of the time. And I think it's not just politicians, but unfortunately, there's a lot of very questionable information out there. People at a lot of the viewing audience absolutely rely upon for good sound information. They're not getting it. We've spoken about Janet Yellen. We've spoken about her attitude towards inflation, that there is none. And as you've mentioned, Alasdair, it's all transitory anyway. And, the RBA here telling everybody that they weren't going to have interest rates. I mean, how can you get it so wrong? Not going to have increase in interest rates until 2024, and then a few months later you start and it's 0.51% month after month after month. But I was watching an interview just recently. The gentleman's name is David Plank. He is the head of economics at the ANZ Bank here in Australia. And he made reference to the fact that the information, because he was being asked about the property market, what impact it would have on the Australian economy. And he pretty much brushed it aside and said, well, look, I've got information here and we can rely upon this. This is from the RBA. This is information direct from them. And he went on to share a couple of thoughts. And I think it's worth mentioning now. But RBA data, so it's got to be accurate, right? He said,
what?
he said, many homeowners have big buffers. I've spoken to so many homeowners since I heard him make that remark. I spoke to a group of 60 people on the weekend, and I asked them if any of them had big buffers, and they all said no. And no one they knew had big buffers. Now, this is coming from a man who should know better. But he also said, point two, banks have been more prudent with their lending of late. More prudent? Like, unbelievable. I mean, right now, a first home buyer, or until very recently, a first home buyer could purchase a property for valued at $500,000 with a $3,000 deposit. And we're talking about banks being more prudent. Point three, most people, check this one out, you'll love this one, Alasdair, most people don't borrow as much as they can. Give me a break. Most people borrow much more than they can afford. I mean, This is a man who should know better, and he's trying to convince the Australian population that this is accurate data coming from the RBA, and so we should feel at ease. Alasdair, what are your thoughts on that sort of response? Because we're getting it everywhere from people who should know better, aren't we?
Well, Darryl, it doesn't surprise me because, I mean, there's several views you can take on this. One is that basically they're all a bunch of idiots and they haven't got a clue what they're doing. I think that's a valid viewpoint. The other is that they realize that things are not going according to plan and that there are significant dangers. So what they have to do is they have to try and calm things down. I'll give you an example of this. I mean, you referred earlier to Jamie Dimon's speech at a banking conference, where he said, 2 weeks ago I said it was storm force. Now I reckon it's a hurricane. That was followed by JP Morgan's chief economist rowing back on those statements the following week. Now, I suspect that what happened is that either Jamie Dimon's fellow directors turned around and said, "Ooh, dear, we better not," or alternatively, urgent call from the Fed, because bear in mind that JP Morgan is the Fed's, if you like, main means of communication into the commercial banking network. Yeah. I think the Fed might have rung up and said, "Jamie, you ought to have said that."
Yeah.
So we get
surprised at all.
Call it expectations management, call it complete ignorance, call it economical with the truth, call it barefaced lies. I mean, any of those descriptions pretty well fits the situation in which the establishment in their groupthink has got itself into. It's dug itself into a hole. The only thing it knows is just keep digging, and perhaps we might even get into Europe from where you are, or we might get down to Australia from where we are. What more can one say? I mean, I don't trust any of them. I wouldn't. And when it comes to statistics, understanding economics is not about statistics. And I go back to something that was said a long time ago. I'm trying to remember the name of the British politician. Yes, Lord Canning. We're going back to 1820. He said, "I can prove anything with statistics but the truth." That, I think, is something that we need to bear in mind. And when Canning made that statement, this was before the days of statistical manipulation that we have now. I mean, computers, wow. Economic modeling, wow. I mean, we can get every statistic we want, and we can get it to show what we want. We can draw charts in such a way that it exaggerates what we want to have exaggerated. Lord Canning didn't have that, but in his day, he reckoned that he could use statistics to tell anything but the truth. So, what's changed?
How things change in the world.
Thanks, Alasdair.
Yeah. Moving forward, Alasdair. You mentioned the word charts, and I've got a couple here that we're going to show. But these are charts not produced by me, but produced by you. And I picked it up from a couple of articles that you wrote for goldmoney.com. So, Alasdair, I'm going to put on the screen a series of charts that you have recently shown in your presentations for Gold Money. They consist of prices of oil, copper, scrap iron and steel, and London real estate. Now, I looked at the London real estate, and I would say Sydney would be pretty close. Yeah. Well, what is outstanding is you show the prices in fiat money, right, what we're using today, and then in the price of these resources in gold. So the first one we're going to show is the price of oil. And this one here is the price of oil between 1950 and 2022. So in Great Britain pounds, in US dollars and in euros. So Great Britain pounds first. There's most of these lines go up at 45 degrees, but right towards the end they go up 90 degrees. But let's say in Great Britain pounds, 1950 to 2022, we're up 83 times. Now, if people don't understand what 83 times is, that's 8,300% from 1950. Now, in US dollars, it's up 39 times, 3,900%. Euros, up 15 times, 1,500%. Now, that 1,500% I think is a bit low simply because the euro hasn't been around for too long, right? Yeah. Then you have a line. Now, the people will put these charts on our screen. If you can't quite see it, there's a line that goes parallel to the horizon, and it's in gold. And that is showing how comparing those other three percentages of 8,300%, 1,500%, 3,900% in gold, the price of oil has come down. Not up, it's come down by 30%. So that's the price of oil. Next, we have a look at the price of copper. So in the price of copper, we've got from the year 1900 to 2022. So we are talking 120 years here. The price of copper in US dollars is up 27 times. In other words, 2,700%. In price in gold, over the 120 years, down 70%. We're talking here where you might say you call it deflation, but it's good for economics to be able to produce something much quicker than you could 100 years ago, and so it comes down in price. It's productivity. We move forward to iron and steel scrap. So, in this particular graph, it comes in at US dollars between 1934, right in the middle of the Depression, to 2020. In US dollars, it's up 69 times, 6,900% over that period of time. Oh, by good golly, in gold, it's the first one that's had a rise, and it's up 32% against 6,900. I mean, we are talking about prices in gold for every commodity that you can think of, right? And there is no price rise. Let's look at London prices, your chart on London house prices. So what we've got here is in London between 1968 to 2022, present day, 54 years, median price of this London home up 115 times. That's 11,500%. In the gold price, that same home up 29%.
Good golly.
Good God. Yeah. Here we are. We got inflation running wild, but in gold, it's either zero or so close to it, it is unbelievable. Now, I will also give you, I can't give you a chart, but I quite often, we have done over here presentations over the last 5 years, and because Darryl and I have been part of the automotive industry, I took notice of what the price of cars are worth. Now, I've said this once or twice, I'm going to reiterate it. The price of a Ford motor car from 1908 to 2020. So 1908, Henry Ford started to produce in numbers, right? And he was producing that Ford Model T for $360 US, right? And right now in Australian dollars, and by the way, that wouldn't have been much different from Australian dollars back then, but in Australian dollars, when Ford Motor Company left Australia in 2019, right, that typical Ford, what we call Ford Falcon motor car, cost $40,000. So, an increase of 10,500%. But in gold, that Model T Ford was 18 ounces of gold in 1908. Today's present Ford at $40,000 becomes 16 ounces of gold. So here we are, a Model T to the most pretty well up to date with all the electronics, navigation equipment, and all the other gear, disc brakes, and the Model T Ford wouldn't even had windscreen wipers, So the bottom line is we've got all the electronic stuff they put on cars these days, and they go 300 mile an hour, right? And it comes down in price. Comes down in price by 11%. I mean, good golly. You know, we talk about inflation and people are overlooking this. Now, I do have a question after all of this. Alasdair, could you discuss why gold has been the superior money and why politicians resist going back to the gold standard?
The answer basically is that there is only one money, and that is physical gold coin or physical silver coin or physical copper coin. And when it comes to standardizing a currency, the most recent metal used is gold, and that is commonly accepted as the money, if you like, that central banks will accumulate on their books as part of their reserves. Legally, gold is money and nothing else. Now, that was said by J.P. Morgan himself. And he wasn't stating an opinion. He was stating a legal fact. The rest of it is credit. And of course, credit is something that gets expanded. If you're a central bank issuing notes, you can expand the quantity of notes in circulation. If you are a commercial bank, then you can create credit out of thin air. And the other side of that credit is deposits. So money supply, its origin basically is credit. It's no more than that. It is in fact credit as well, because when you have a deposit with a bank, you don't actually own the deposit. The bank owes you that credit. So, I mean, that's the basic situation. What is fascinating, I'd like to sort of just digress slightly from the points which you were making. If you look at the relationship between money and the prices of goods, the idea in a transaction is that, the three of us will know what a dollar is. We know what a dollar will buy. We assume that all the volatility in the price, if let's say I want to buy even a coin from you, a gold coin, we think all the volatility is not in the currency, but in gold. So, we will negotiate over the price of gold measured in dollars. And what this is, what we call this is that all the subjectivity in terms of price is in what you're buying with your currency. The currency is assumed to have no volatility for the purpose of the transaction that we're talking about. Now, we all know that over time, the purchasing power of the currency will change. But in terms of the transaction, the assumption always is that entirely the volatility is in what we are buying with the currency, not in the currency. Now, you ran through a series of charts there. What the charts tell us is that with gold, of course, that is broadly true. You will get some variation in the purchasing power of gold, say measured in copper or measured in the London housing market or whatever it might be, and particularly oil. But that variation is pretty minor. And, we can assume that if you have got gold as money, that in 40, 50 years' time, it will buy the stuff that we need or the commodities we need more or less at the same price. I mean, there may be some variation in it, but not a huge amount. But the other thing that this indicates, because if you take that logically, then what you're seeing stability of prices measured in gold. But look at the price in sterling, US dollars, euros, Australian dollars, whatever. That's where the volatility is. So actually, the whole idea behind price theory, that it is the currency which is stable in terms of, and we can agree on the purchasing power when we do a transaction, it is the goods that we're buying which go up and down. And, we talk about, will you knock 10% off? It's not 10% off the currency, it's off the goods. Okay, that is completely false. All the volatility is in the currencies. So there actually, the subjectivity is in the currencies now, not the commodities. So the whole of price theory has just been stood completely on its head by what governments are doing with their currencies. It's fascinating. It's a fascinating topic, but it's really, the debasement of the currency. There's no sheet anchor for the currency. I mean, we can take the gold thing all the way back. I mean, I was looking at some of the prices that Diocletian fixed in the year 260 or something, 230, whenever it was, that he tried to stabilize prices in Rome. And he put in an edict of maximum prices. And if you look at things like, the price for a short jacket measured in gold is exactly the same as the price of a blazer today, measured in gold. I mean, after what, nearly 2,000 years. I mean, so the stability is not just from the mid 50s, or in the case of copper, I was able to take it back to 1900 or wherever it was. I mean, this is the point about money. You want money to be stable in terms of what it is. Why? Because if you don't want to spend your money immediately and you want to put it to one side for spending later, you want to be sure that it will actually buy what you want later at little or no change in the price. You cannot do that with a bank deposit. With a bank deposit, you know that you're just going to, just sitting on a bank deposit is the surefire way to lose purchasing power of your money, which is basically the proceeds of your labor, your work, whatever it is you do to earn money. You earn that money. If you try and save it in a bank account, they just rob you. I'm not saying the banks rob you, but I'm saying the government does by debauching the currency. Yeah. So that all the volatility now is in the currencies, not in gold. And that's interesting for us chaps looking at gold coin, silver coin, so on and so forth. I mean, we've got to look at it the other way around, really, from what we usually do. And the way we're encouraged to look at it, it's not just a question of, the price of gold is going up. No. If the price of gold is going up, it's because the purchasing power of your currency measured in gold is going down. And that's always the way in which you should look at it. And if you understand that, you begin to understand actually what physical gold coins and silver are all about.
I have a question before we carry on to the next question, because I mentioned politics or politicians in that question. And I know you obviously came out of university with a degree in economics or something very similar. I came out with not a degree, but I know how to run a business. And yet these politicians, what do they come out with a degree with? Being a dunderhead or something? Because at the end of the day, none of them understand economics, and they are the biggest spenders in every country. Is the politician spends your money, right? And for the life of me, I just cannot believe how these politicians overlook the subject of gold and money. Anyway, we move on. So one last question from me, Alasdair, and I will let Darryl take over. This question involves central bank digital currencies, as we know it, or not many people maybe know it, but CBDCs. Right? I would like you to run through the difference in living with a monetary system using CBDCs against a currency that uses the Austrian Economics as its base. Obviously, gold and silver coin or backing of comes to mind. If you can, please give me the constraints of living when using CBDCs. For example, using China as an example.
Oh. Well, first of all, what a CBDC is it is a currency which is issued in the form of not notes, but a bank account. It is a deposit that you have directly with the central bank. And it bypasses the commercial banks entirely. So what this means is, as far as the state is concerned, they're attracted by the idea that they can monitor exactly what you're doing. They can deny you access to money if you are a criminal. They can deny you access to your money if you don't pay your taxes.
Describe a criminal. No, we won't go into that. But go on, please keep going.
So this is something which control freaks, if you like, in government, and particularly in this case, we're talking about central banks, particularly like. There is a further subset to this, and that is that they can use the issuance of CBDCs instead of as a general expansion, if you like, of the quantity to stimulate the whole economy. What they can do is they can use it to target areas of the economy that they want to grow. So there might, for example, be a push towards the development of aerospace. So what the central bank can do is it can make CBDCs available, at a suppressed cost, if you like, of an interest cost, or just, put straight into the printed and stuffed straight into the aerospace industry, or their targeted businesses, which of course are all crony capitalists, they must be, in order to stimulate that thing. So you can see that the Keynesian economists who are finding that their systems fail, and of course they don't blame themselves, they blame us, we're the idiots here who don't do as we're told. It allows them to have greater control over outcomes. And that basically is the attraction. So you can understand how in a country like China, this is likely to appeal quite a lot to the Chinese administration as a means of controlling their population, controlling outcomes, and so on and so forth. So I think if I can leave it at that, just from that point of view, there is a problem with this, and this is why it won't get any traction at all. Look at the American situation. The Americans, along with every other central bank, are conducting research into CBDCs and all the rest of it. But because it cuts out the commercial banking system entirely, and because it requires politicians to vote in new legislation, and because the commercial banks in America bankroll the politicians, you can begin to understand that the commercial banking network are not going to vote for like turkeys for Christmas. No way. And so they will, through the pockets of politicians, ensure that this legislation doesn't get off the ground. Yeah. And if it doesn't get off the ground with $1, you can forget it elsewhere.
Yeah.
So I think this is a point which nobody really sort of seems to think about. I mean, it's the idea of CBDCs is all sort of rather nice, airy-fairy idea of, it'll allow government to do this, do that, and all the rest of it. But whether it actually comes into an existence or not is something that people aren't really considering. But that would be my answer, that this will never be voted in because banking interests are completely against it.
Thank you very much, Alasdair. That's a fantastic answer. All right, Darryl.
Well, I'm interested in Alasdair's answer to this question as well, of course. Right now, Alasdair, it goes without saying that the demand on us and all bullion dealerships around the world at the moment is massive. Sales are just through the roof. We are run off our feet, and we're loving the heck out of it, aren't we? But obviously, there is a question that's being asked quite regularly, because one would think law of supply and demand on metals, huge, both metals. Why isn't the price of gold and silver surging at the moment? Now, this would appear to be the perfect economic climate for both metals. So it's a fair question. If you could provide an answer, your answer as to why that is the case at the moment, Alasdair.
Yeah, sure. I mean, there are two aspects of this answer. I'll deal with the one that's probably less important first, to get that out of the way.
Okay. Yeah.
The whole of the establishment works on Keynesian economics, not classical economics and the understanding of the difference between money, currency, and credit. And what this means basically is that as far as they're concerned, gold is a pet rock. Yeah, I mean, that's the way someone, I can't remember who it was, described it. And it's as a metaphor, it actually sums up the attitude, if you like, of the establishment. Not so much talking about central banks. I'll come to them in a moment. But I'm talking more about investors, if you like, the investor community. And if you look at hedge funds on COMEX, I mean, they just do a twin a twin trade. It's, they either buy dollars, sell gold, or sell dollars, buy gold. So what happens when you get the trade-weighted index rising? Not because the dollar is a wonderful thing all of a sudden, but because the other currencies are rubbish, more rubbishy than the dollar. Well, what you do is you sell gold, buy Dixie, which is the if you like, the ticket for the dollar's trade weighted. So, this is why we have seen the traders sell it down. Now, the other thing is that I don't know if you noticed, but there's an old timer in the market called Peter Hambro, who has been dealing in the gold market since the 1970s. And Peter more recently set up a gold mine business in Russia, which has had taken from him and has just unfortunately gone bust. So, I mean, he had a very unhappy experience about that. But he put out an article recently saying that when he started dealing, and he was dealing with one of the big houses in London, there was this move from the Bank of International Settlements to get all the central banks, and more particularly their exchange stabilization funds, to create paper gold to suppress the price by, if you like, diverting demand that would otherwise go into physical gold into paper. And from a bank's point of view, it's actually very, very simple. I mean, I can run a position, unallocated gold. I can say, Darryl, I will offer you can open an account with us for unallocated gold. Now, let us assume I'm JP Morgan or someone like that. Entirely trustworthy, very large, never going to go bust. Yeah, okay, the convenience of doing that, I don't actually have to own it. I don't have to pay storage fees and all the rest of it. Yeah, I'll open an account. So I open an account. Okay, what are the mechanics behind that? You go in and you say, right, I want to put $1 million into my account, into my gold account. So, okay, so you now have an unallocated gold account of $1 million. Where does that come from? Well, it's quite simple. I just expand my balance sheet on the other side. I just create it out of thin air. And that's what happens. And that's what's happened. And this was particularly shown in a chart which was produced in the last quarter's figures by I think it's the Comptroller of the Currency, I think is the title, in America. And there was a big change in the outstanding quantity of gold derivatives. It sort of shot up 90%. No, sorry, 9 times, 10 times. Get it the right way around. Now, the answer to this was there was a change in methodology, because before then, it had been regarded, gold derivatives had been regarded as foreign exchange derivatives. So they were in that category, so didn't show. Under Basel III, the Comptroller of the Currency decided that actually this should be included with precious metals. So it was moved into precious metals and this exposed the full extent of the American banks' positions in the paper market, principally COMEX, but it'd also be forward deals, whatever, and anyway, and the whole thing. The other thing that was interesting is that the vast majority of this was JP Morgan. Going back to the story that Peter Hambro was talking about, who would the Exchange Stabilization Fund in the United States or the Fed work through? JP Morgan, of course. They would be the principal dealers. And the second one, sort of bit minor, was Citibank. Now, the interesting thing is that JP Morgan has been suppressing the price of gold through expanding the quantity of paper gold and dealing in such a way to knock the price, for which it was, I think 5 years ago, fined $930 million. And now its senior traders, one of which I think was a board member of the LBMA, are now on criminal charges in America. So we've got this extraordinary situation where, they're doing the government's work, yet they end up being charged. I mean, I think probably a deal will be done, and suddenly all these charges, will be found not proven or something. But I mean, this is what goes on. So, trying to understand what happens with the gold price, it is being ruled by this mountain of paper, which can be created at will. But what the smaller bullion banks are now concerned about is that while dealing has been very, very profitable for them on the short tack, they need to close those short positions because they do realize that the inflation problem is a problem. They will spin it that rising interest rates is a deterrence to holding gold. I mean, they always say something silly like that. Even though the evidence is very much the contrary. I mean, I won't go through where the theory is wrong, but just look at the evidence. I mean, we went into the 1970s with the Fed funds rate, or in those days it was prime rate, around about 6%, and the gold price at $35. And then we came out of it in 1980 with the gold price at $850 and the rate at 20%. So, look, it's complete anything they say is just complete nonsense. They're talking their book. And this is why I think that, it's probably got to the point where they can't sell it down anymore. They may be able to, I don't know. But it's getting to the point where we are getting into a major financial crisis, which is what we were talking about earlier. And under that major financial crisis, what happens? You get a substantial contraction of bank credit because the banks go bust. And that means that people try and get out of bank credit. They try and get back into currency, like folding notes, of which there are very few around relative to the amount of bank credit now. And they try and get into gold. And so you will find that I think suddenly either you've got gold or you haven't. And if you haven't, wow, tough. It's going to be a bit like that. So, and the thing that's fascinating about what you're saying, Darryl, is that you're seeing lots of people now effectively taking that view. They're not looking at the price in the market. They're thinking, I better have some gold coins.
Correct. Yes.
And this is a very interesting change. And I hope that we're making a contribution to the understanding as to why you should buy gold, which these people obviously have. I mean, they've taken the message, as opposed to people who are looking to trade it. I mean, I get emails from people who are disappointed with the way the price of gold has traded, and why is it's got down to this level and all the rest of it. It's because they're investors. You don't invest by buying money. Basically you invest by buying securities or by buying the paper equivalent perhaps of money, or, but not real money itself. Real money, if you like, hoarding real money is for safety. And it's not something that you're buying with a view to selling at a later date, which is the whole raison d'etre behind investment.
Alasdair, I can't add to that. I was going to, but I can't. That is a wonderful explanation. It makes absolute sense. At some point, and I don't think we're going to have to wait too long, the price of the metal will explode. Of that, there is no doubt.
Let's put it another way, because what I was saying about the charts, which yes, Brian was showing, is that actually what happens is that the paper currencies collapse. That's the point. So it's not so much the gold price, right? It's a collapse in purchasing power of the paper currencies. I think that's the key to understanding it. Yeah.
Right. I won't expand. No, I won't expand on that. Alasdair, thank you so much. Look, thanks for your input again this evening. always well received, and we keep on, our subscribers keep on reminding us that we need to keep on interviewing Alasdair Macleod. So thank you so much for your input. I guess it's we can only make reference to Jim Sinclair at this point. Jim, of course, says become your own central bank. He doesn't like the central banks, but they do own gold, and they own it for the same reasons that we do.
We own it.
And that's to be in control of your destiny. You've got to hold money outside of the banking system. Peter Daniels, of course, would always say, I do not care what poorly executed economic decisions are made in the world tonight, because tomorrow I will still be able to party. Why is that? Because he owns gold, so he's in control of his life. And Egon von Greyer's, of course, how much should I invest in precious metals? Brian, what does Egon say?
Well, it's different for everybody, Darryl, but Egon's approach is that whatever you can't afford to lose, that's what you have in gold.
Yep. So it's a powerful statement. Once again, Alasdair, thank you so much for your support, your ongoing support for As Good as Gold Australia. It's very much appreciated. And we look forward to a very long-term relationship with you. Until next time, to all of our viewers and our subscribers that continue to support this channel, stay well, stay focused, and goodbye for now.
And goodbye for now.